Howdy, Jacob here. Today we're looking at Certara in the healthcare technology industry, 2.6 billion market cap, slightly higher enterprise value. Looks like they provide software products and technology-enabled services to customers for biosimulation and drug discovery, preclinical and clinical research. Founded in 2008 out of Princeton, New Jersey. So haven't been around quite a while. Revenue growth appears to be pretty substantial. Gross margin very solid, about 60%. No or very little operating profit at this point, and that's obviously affecting their return on invested capital. So let's see whether they're putting a lot into R&D, and it looks like they are putting a bit of their investments and expenses into research and development. Again, when you invest in R&D, you're taking money away from now to hopefully get more money later, and not everything is going to pan out. But let's say even if they reduce their R&D by half, 17, 23, take out those operating incomes, I mean, you're looking at, I guess their net interest is 23, so it'd really just wash out to zero at this point. But they are still reinvesting pretty heavily into themselves. So we're going to be creating a story around this business and understanding that you're likely going to need an extra margin of safety for this company that doesn't have a whole lot of history of margins. And the more things that you're assuming, the bigger your margin should be. Balance sheet is 235 million cash on hand, 288 million long-term debt, 3 million short-term debt. So they have almost enough cash to write off their long-term debt. It's about 50 mil over, and they do produce over 50 million, at least they have, from free cash flow the last 3 years. So we're not terribly concerned about the balance sheet. Depreciation and amortization is way above their capital expenditures. So they are writing off quite a few things and depreciating and amortizing quite a few things. And in doing so, creating a much higher free cash flow. Again, you'd have to look at that, see if it makes sense or not. I mean, you get taxed based on your net income, or you get taxed on your pre-tax income after operating profit, interest, income, and other non-operating income. And so for it to be negative means that they're really not paying any taxes and they're producing free cash flow. So that could be a positive thing. But again, you'd really have to look at what they're depreciating and amortizing, see if it makes sense to you. And anyways, their use of free cash flow at this point seems to really just be acquisitions. They issued quite a bit of shares in 2020 and 2021, but haven't really since then. Debt repurchase or debt pay down is very abysmal, not much there. Really just acquisitions at this point. And their stock-based compensation is fairly high, 29 million. That's going to be about 1% of their market cap, so we will have to put that into our assumptions. So let's get to it. On the revenue growth side, I think on the revenue growth, it's gone down quite a bit the last year. If they can go back to those 17%, that'd be huge. I'm a little skeptical about it. Being a very conservative individual, I like to, not be as aggressive. And so for me, 8% revenue. For margins, I'm going to lean on the free cash flow margin a bit more. And in doing so, we're looking at, what are we looking at? About 15%, maybe 10%. Share change, 1%, because again, we saw stock-based compensation was roughly 1% of their market cap, saying that they don't issue any more shares. They're growing a lot through acquisitions, so let's really just do market average at this point. And right now, it looks quite a bit expensive. Again, not really terribly surprised here. We are creating a story. I think an extra margin of safety is also necessary and needed. But for me, I just don't think it's obviously attractive. I don't think the growth, even at 20%, is going to make a whole lot of sense here. So for me right now, I'll just be waiting and reviewing other companies. So I hope you enjoyed the video and have a great rest of your day. Thank you.